Well, good afternoon, everyone. Welcome to our webinar, Considerations for Private Credit and Alternative Income in a Dynamic Market. I'm Steve Biggs. I'm the moderator today. I'm co-chair of the Members Programming and Content Committee for the CFA Society of San Francisco. I also head alternative investments, so I'm an allocator at the Mather Group. We are a registered investment advisor, manage about $10 billion from anyone from high net worth to multifamily office clients. And it's my pleasure to introduce our speaker for today. I know many of you were expecting Kristen Jones to join us. Unfortunately, she had a last-minute emergency to attend to and is unable to make the panel, so it will be more of a fireside chat format. And joining us is Eli Sokolov from Cliffwater. He's portfolio manager for the Enhanced Lending Fund and leads credit research at Cliffwater. So I will turn it over to Eli. Eli, tell us a little bit about your role at Cliffwater.
Sure. Thanks, Steve. So I help oversee our overall private credit research and as well as portfolio management, as you noted, for the Enhanced Lending Fund. Been at Cliffwater for about 16 years, spent a lot of time over that time covering credit strategies, from public market strategies in the hedge fund side to opportunistic credit and private credit.
Well, thanks. So 16 years, certainly a lot of tenure in the private credit space. I mean, certainly it's been an area that's changed a lot over time, and certainly it goes back, obviously, decades. But since the global financial crisis, things have changed, obviously. So it's certainly grown. What does the supply of capital look like from currently from the manager perspective, and what parts of the market may be under-recognized today?
The supply of capital in private credit has been pretty strong. I think generally the market has both been responsive to with the needs of borrowers across the spectrum, as well as creative in ways to fund corporations or assets or whatever the borrowing entity happens to be. And as a consequence, there aren't really any sort of hidden niches in the market. There are areas that are more specialized, maybe less scalable, and less competitive because the fixed cost of doing business can be high relative to the potential revenues generated from operating that business. But generally speaking, it's fairly competitive. I think the a long and lasting period of low yields created a lot of drive for people to search for higher yield in various areas, and that's definitely played out in terms of the breadth of opportunities for investors to get access to private credit.
Great. I should have mentioned, if for anyone that wants to ask a question, just hit that Q&A function and type your question in, and we'll try to get to it either during the presentation or towards the end. So following up on that, I mean, obviously direct lending and in particular sponsored credit are large markets. I mean, that's what we see the most of. How do you think about using those in a portfolio?
Well, I mean, at the size of the market where it is today, it's effectively an asset class of its own. I mean, you could argue that it's part of the overall, credit asset class with a sort of liquidity premium built on top of it. But either way you look at it, it's such a deep and large market that it operates effectively like an asset class, and therefore, sort of the way we think about it should be part of a long-term asset allocation, with sort of a budget reserved for it.
And what do you think about some of the more niche areas, or some of the more specialist areas? Is that too narrow of a focus? I mean, can too much capital flow in? Would that push maybe a manager to go into other areas that perhaps they're not an expert in?
Yeah, I mean, that's always a risk, right? I mean, strategy drift is something that is a risk in whether it's could be small buyout private equity, it could be hedge funds, it could be any strategy, small cap equities. a lot of strategies are prone to, the risk of drift, and private credit is no exception. And as I noted, there are areas of private credit that are more specialized, more niche. Some of them, sometimes it's as simple as evaluating strategy drift on the basis of, as I kind of alluded to with those examples, the size of the opportunities that managers pursue. But other times it's a little more nuanced and, kind of buried a little bit in the risk statistics in terms of the types of assets or companies that they're lending to, and the terms on the debt that they're tolerating, et cetera. So those sorts of things are part of any allocator who's doing due diligence on a space needs to focus and pay attention to, and especially if they've made an investment and are monitoring it, because that's always a risk. The pressure for managers to raise assets is understandably high, because they're in the end they're running a business, and not, especially as returns in a space shrink, and therefore incentive fee becomes less valuable, and they rely more on management fee. That's something where the incentives can be there to grow a little bit outside of their core area of expertise.
So I feel like we should really be, if we're going into less scalable strategies, either as a particular fund strategy, something to monitor much more closely.
For sure. I mean, monitoring is a key part of any investment process and platform. And it's really just, ultimately when you go into an investment, you have to sort of have in mind no investment that you recommend or that you execute is without risks and without its potential concerns. And so knowing up front, okay, sort of having identified the areas where you think there could be slippage or where you think there's things go wrong, helps you stay focused on keeping track of the relevant metrics. And as I said, for less scalable strategies, one of the metrics could be the size of the opportunity, but not necessarily, right? It's never just one variable you can rely on to make judgment. Like, for example, we don't just say higher debt in corporate lending, that higher debt to EBITDA means higher risk. Well, the lower debt to EBITDA loans tend to be to more cyclical or smaller or otherwise higher risk businesses. And so the market's reasonably efficient at pricing that risk. And so you always have to sort of make sure that you have the right calibration to what you're expecting and looking across multiple variables.
So one of the more narrower opportunities that came up from the questions pre-submitted by the audience, you mentioned that you might have opinion on it, is venture debt. So we've heard a little bit about venture debt. Been some challenges on the equity side, but love to get your thoughts on the credit side.
Yeah, so venture debts are the way we've always looked at it is there's sort of two sides. There were, and we'll step back. This is before the tech markets had a downturn last year. We just think about sort of the ecosystem and the motivations for venture lending. The bull case for venture debt at the time was that you have a lot of borrowers who are playing for a high equity multiple, and equity is very precious to them. And it's expensive capital. Therefore, there's a willingness, and they tend to not need a lot of debt for what they're trying to achieve. So the interest costs that they're absorbing aren't that high relative to other businesses that are more stable businesses that are sustain higher levels of leverage. And so the absolute interest cost that they're willing to sustain is higher, and therefore there's some value that the lender is extracting from this dynamic. The flip case is that you're getting negatively selected, that the venture companies that are actually for whom equity is more expensive to issue are the lower quality companies. So you're getting negatively selected, that the borrowers who the companies that are looking to finance partially through debt are going to be the lower quality companies. I don't neither one is 100% correct in my mind. But what I can say is that since the tech markets declined in value, that equity became more expensive, and therefore the risk of negative selection bias decreased. Then you had Silicon Valley Bank and the First Republic and the others that had issues, and there was sort of a view at that time that perhaps this could create, a big tailwind for venture lenders. It hasn't really, but this sort of in terms of real stressed capital solutions, rescue finance type opportunities, those haven't really materialized. Certainly not in big volume, but it's still a decent backdrop, as part of the story around, the value proposition of borrowers for venture debt and therefore the value extraction by lenders. We think that story still persists. Like with anything, I mean, you're typically lending at, in this case, at very low LTVs, but with the V being very volatile and sort of dependent on an exit path that is uncertain. And so, yes, it's great that they're very low LTVs, but you need to keep in mind that that sort of realizing that V can be episodic and subject to a lot of event risk. And therefore, like with anything in credit, diversification is really key. So it's not a market that's been fully tested yet, gone through a full cycle, but it has absorbed a lot of bumps with the disruptions in the tech market and performed pretty well. So.
Okay, great. And you mentioned some of the bank failures we've seen. So the other part of the market that those banks and other regional banks were active in is the real estate market. So, with that distress, I think we've seen most of those regional banks really largely exit the real estate lending market. And in addition, there's obviously dislocations in part of that market as well. Where do you see opportunity for credit investors there?
So, first thing you got to do when you're looking at real estate, I think this is probably obvious to everyone here, is to separate office out from everything else, because office is in it's its own idiosyncratic story. The sort of consensus view is it's sort of a secular decline story for all the reasons we know in terms of the post-COVID work environment. So you've already seen some true distress situations in office that have been big headlines. I'm sure there are others down the road. And so from a allocated perspective, I think the right way to think about office lending right now is as a distressed play. And there could be great opportunities, but obviously the values there, speaking of uncertainty and value, like with tech, like with venture companies, it's certainly the case with office. You don't have the transaction volume to have the confidence around, where the equilibrium value of a lot of these properties is. So put that aside. In terms of the other areas within real estate, the story you tell is absolutely real, and everyone's probably seen the headlines around this great, this looming maturity wall. I think, people who've been covering credit long enough sort of know to roll their eyes a little bit about, the maturity wall boogeyman, because in the end, it's, we all think it's going to be another 08 where suddenly they use all these desperate sellers of paper. That's unlikely to be how it manifests. A lot of it's going to be extended, particularly if it's bank-led lending and it's relationship lending. That's going to persist, and there's going to be true distress situations where keys are handed over. But for the most part, I think history tells us anyway that it should be a a transition that is not too disruptive to the markets, and so which is a good thing, obviously. And I think as part of that, you're not really seeing right now a lot of big opportunities to extract alpha from a lender perspective. There are obviously anecdotally a lot of examples, a lot that we've seen ourselves, but in like large scale, not really yet. I think theoretically, right, you have a senior lender community in these regional banks who are now, largely pulled back from the market, and those that remain are going to be more conservative in how they appraise the properties they're lending to, and probably more conservative in the loan to value ratio they're willing to lend to. So theoretically, that means that for a lot of properties, there's going to be a capital gap, which could be filled by mezz. And mezz is one of those sort of once in a cycle opportunities, and that might be happening out in real estate. Again, we've seen anecdotally some examples of that, but we haven't seen like a big surge in that supply due to sort of desperate borrowers, et cetera. And if you look at also like where new loans are being done, they're for like for alternative lending and alternative private credit, a kind of typical real estate strategy is what's called transitional lending, where you're lending to properties where there is some sort of light rehab. It could be more heavy development, but somewhere in that mix, of bridge capital needs to a take out in 2-3 years. Sort of the thesis being that the borrower, once they stabilize the property, can access long-term cheaper financing. And then so those strategies those managers and strategies that provide that bridge lending, then they typically get leverage of 2 to 2.5 times on that to generate the returns that institutional investors in the space demand. And so the asset spreads there, the actual loan spreads have moved up certainly, but so has their cost of financing. And it's not like it's been, most real estate lenders today are focused on multifamily and industrial, and that's sort of like the comfort zone, the consensus view of sort of the safer property types to be within. And so there's still a lot of capital pursuing these opportunities, particularly if they're backed by large sponsors, large well-capitalized sponsors, whose names we know here. That provides a lot of comfort to lenders. And so for those sorts of profiles of loans, you're not seeing like these, really big differences in the spreads that available to lenders now versus, before this recent banking issue. And on top of that, again, their cost of financing has gone up, not to such an extent that it erases all that spread, but it certainly carves it back a little bit.
So maybe not as attractive as
well.
Thinking.
I think it's attractive. I think you're also generally seeing better terms, and again, the loans are being underwritten to more conservative appraisals and more conservative LTVs. So it's not just about spread. So relative to where it was, arguably it is a little more attractive, but the market's pricing in a slightly higher risk of loss, which you could argue you should expect because property valuations are cyclical, and there is a lot of economic uncertainty right now. So my point being, it's yes, relatively better, but it's not screaming like lenders are extracting a ton of value from the system right now. That's just not happening.
Okay, great. Going on to the risk side, just in general, not necessarily real estate, but a lot of the market has been established and developed since the global financial crisis, and the only kind of we had a little bit of a cycle during COVID where I think we actually did hit a recession, but obviously the system was flooded with cash, and we didn't really see, I don't think, a real test. So without kind of a real test to the resiliency and correlations of some of these smaller, more narrow focused asset classes, how do you assess risk and underwrite new areas?
Yeah, it's tough. It really is. But it's a good reminder, by the way, that when you're analyzing a strategy or a manager, being too backwards looking is not sort of does not lead to necessarily the best informed judgment. So you could take direct lending, where we do have a track record for a lot of managers and for the industry overall, through the financial crisis. Granted, it was a, different, less developed market and strategy and asset class, so to speak, back then than it is today. So you gotta, weigh that a little bit. Even so, you have to adjust for that fact, right? This is a different market, and also for the fact that you have to make sure, going back to our topic earlier about sort of strategy drift, that what's being done today by any given manager or platform is representative of what they were doing in that period, and that that's or what the industry overall was doing. And so so there is some comfort in direct lending that you have that, but I mean, actually a lot of comfort, but more of the comfort comes from, okay, what are they underwriting to today? What sort of leverage levels are these companies assuming? Are these companies in these industries used to sustaining leverage of this magnitude? How have these industries performed? Companies that have this much leverage. The size of the company today, direct lending is no longer just a middle market phenomenon, right? It's gotten, especially in the last couple of years, it's really gone up market. You have individual lenders writing $500 million checks as part of a bigger multi-billion-dollar loan, and so that's a very different market than it was, 15 years ago, and in a good way, because larger companies are generally less risky, and so it can sustain higher levels of leverage. And and from a lender's perspective, that yes, there's a lot of more covenant light now, but if it's a larger company and less risky company, the existence or significance of covenants, a degree of covenants, I should say, is sort of going to go up and down with the level of risk appropriately. But to your specific question about strategies that don't have that history, so that's you have to apply that same lesson, just without that sort of extra comfort you get from seeing it perform through cycles. Like, for example, real estate, I mentioned this transitional lending. I haven't seen a good index of like these transitional loans and, going back through time. But, you just always got to keep in mind, real estate is a cyclical sector. Obviously, you have to differentiate by property type and class of building and all that sort of thing. But just high level commercial real estate is a cyclical asset class. And so that any judgment you make in terms of the attractiveness or the risk of loss has to be in the context of sort of your top-down view. And if you don't have a top-down view, you can sort of fall back on diversification, which is important always. But that's one thing. If it's something where take like legal finance, for example, right, where it's a really nascent, semi-nascent strategy and an asset class, there it's only the argument would be, well, how does it perform through cycles? Doesn't matter, because it's an acyclical investment. The sources of risk are not correlated to the economy. But we don't think so. But that hasn't been tested, so we again don't know for sure. A lot of times people get hurt the most by the things that no one saw coming. But that's where you just have to go deep into the underwriting, understanding the risks that are being assumed, and how they're being mitigated. And there's all sorts of ways that litigation finance can be risky, more than just the obvious one of the binary bet on whether the judgment's going to be in favor of the plaintiff or not. That's obvious. It's those are like looking for multiples on your money type opportunities for lenders. But that's not sort of the bulk of what people are doing, and the bulk of it is sort of in like mid-teens type yield opportunities, where it can be even things that are post-settlement, and so there's a different sources of risk, but it's there are a lot embedded in there. And I think the best way to mitigate that is to talk to as many different participants as possible, do as many reference checks as you can on the industry, try to find out where things have gone wrong and why, and then use that to inform how you evaluate opportunities. Now, try to be as prospective as you can be, knowing that you're operating in a world of uncertainty, because that is the nature of investing. You're always operating under a world of uncertainty, and just avoiding confirmation bias is the other thing. That's something that we're all subject to, we're all prone to. If you like something, it's so attractive, it looks so good, you're going to look for reasons to do it. Always be mindful of that. You're going to be your natural instinct and fight against it, and look for information that contradicts your thesis.
Well, great. And private credit, we've seen, I mean, the default rates have been lower than, say, bank lending. So how can the private credit managers work to reduce defaults and also higher recoveries as well? Yeah. And in some cases, are these just terms extended with a low likelihood of actually, making good on the loan?
So the risk of extend and pretend is real. It's something that banks historically have been most sort of accused of, right? Because a lot of banks, they're in the relationship lending business, and preserving those relationships is understandably very important. But it's not like the private lending community is not subject to that as well. They have, like, in direct lending, their sponsor relationships are very important to them. That's their source of deal flow. And so working with borrowers is there's an extra incentive to do that. That said, I don't want to be too cynical about it, because working with borrowers through difficult times is a way to avoid deadweight loss. You're not always going to get it right. Some of these companies are going to be in decline, and you're just delaying the inevitable. And other times, COVID was a clear example of this, and where you're working sort of as a partner, and sort of everyone has a common interest in seeing the sustainability of your business, understanding that it's going to go through some difficult times. And the great thing about private lending is that you're dealing with a smaller group of lenders, and therefore a greater ability to find consensus around tools and avenues to work with those borrowers, as opposed to the broadly syndicated market, where you can have a widely disparate group of lenders, some of whom are constrained in what they can do due to, for example, CLO managers, although they have more liberty today than they did 10 years ago under the docs. But irrespective, the smaller the group, the better it is. And as soon as you start going through restructuring, especially if you're dealing with like multiple layers of the capital structure, you just start siphoning off value to lawyers, restructuring advisors, and also probably the business is losing customers around that time due to uncertainty. And so there is a lot of benefit of extending and working with the borrower. And it's not always just that sort of cynical, oh, it's just extend and pretend. Yes, there are going to be some like that, and there are some incentives for managers to do that, preserve their track record, preserve their relationships with sponsor community, et cetera. But you have to take the sort of constructive viewpoint as well around that.
Thanks. And I mean, speaking of that, I mean, the environment's a bit different today than it has been for most of the I guess lifespan of private credit. So I mean, how does that impact how you assess risk? And I'll tie in an audience question here. One that came in ahead was, in light of the rate pressures that we're seeing, I think I heard a lot about, when Fed first started raising rates, used to get that question a lot with credit managers. Maybe seems like we get it less now, but maybe there's some complacency out there.
Yeah, look, the rate of rate increases was pretty steep. It all happened, it's all happened fairly quickly, and now it's leveled off a bit. And I'm not a forecaster. I don't know where it's going from here, but we will so far. Earnings growth has largely kept up. There are always, exceptions, and you're definitely seeing debt service coverage ratios come down. And, a growing population of borrowers where the debt service coverage ratio is under 1. But the answer is, I think the next 6 to 12 months will tell us a lot, because you're now starting to see these higher rates be baked into a full trailing 12-month period of earnings. But we're seeing pretty good signs around economic growth. The numbers that came out today have all been pretty strong. But we're all-in interest costs and borrowers have sort of remained flat over the last few months, so that the pressure is not building up at the pace it was 9-12 months ago, and that's helpful.
Great. I've got they go into audience questions here. So what is the biggest risk for the private credit market as a whole?
A recession, like anything, right? Most private credit is economically sensitive. Again, we talked about some areas that are less so, but negative growth. I mean, ultimately, you're a lot of this private credit is predicated on having a certain amount of cushion above you in terms of the asset value and the LTV you're lending to. To the extent that that cushion shrinks, that means that's on average. When the average comes down, it's likely also the tails are going to widen, particularly the left tails, and so you're going to have more sort of troubled loans in portfolios. And I would say the other risk, and I'm not saying that this is necessarily a huge risk, but it's as allocators are looking at opportunities, this is a risk factor to evaluate, is financing. I mentioned real estate. A lot of those strategies, lean on like a 2 to 2.5 times type of leverage ratio. Not all leverage is created the same way. Borrowers or lenders rather, when they're getting a warehouse facility, for example, they can have the option of borrowing cheaper with a 2-year hard maturity type warehouse facility, or borrowing longer and paying up for it. Always pay up for that, because the one thing you never want to make a mistake on is asset liability management, because it can take you out of the best investments. It's sort of and on top of that, it's also a source of systemic risk. Meaning, for example, like if you had some esoteric strategy that was uncorrelated, but it relied on leverage, and that leverage is provided by the same banks that are tied to the overall economy, you are correlated now, even though you think you're not. Unless you've locked up your financing, it's match term, non-mark to market. And so that's another potential source of risk that all investors should pay a lot of attention to.
Well, it seems like we usually learn a lot about correlations during an economic downturn. So
correct. It's always the hidden ones, right?
Some of these specialty finance areas, royalties, litigation that you don't think you're correlated, sometimes it can turn out to have more than you think. I got a question on annual origination volume and its growth over recent years. I mean, do the interest rates impact that?
I think what's more affecting origination volume is just the overall cost, right? Because what you saw in direct lending over the last 12 months is, as the banks pulled away from the syndication market, a lot of the opportunities that would have gone to the BSL market came to the private market. And so it wasn't just rate increases, higher spreads too. That's starting to come back a little bit now. The market's competitive. Spreads are, over the last few weeks, couple months, market spreads are compressing again. But that's certainly the case that costs have increased. And when your costs increase, the borrowers that don't need to access markets are going to wait, right? And so, because the bid ask is wide until borrowers need to. And so that tends to limit origination. Obviously, M&A activity will be a big factor in that, right? So far year to date, lenders are kind of behind in deployment because the M&A environment has been pretty slow for the first half. And so that's a factor as well.
Is there plenty of investor capital coming in? I know if we look at the private equity side, their fundraising environment has been pretty challenged.
Fundraising overall is harder. Even sometimes for the larger, more established shops, it's been harder over the last 12 to 24 months. But there's still capital being raised. There's still allocations happening, and So yeah, I think that's how I'd characterize it.
Okay, great. We have some questions on, let's see, how do you think about selection of a private credit manager, and what might be some of the top dimensions to evaluate managers on, given the depth and breadth of the market? I know you're a manager yourself, but it'd be great to have some insights on that.
Yeah, I mean, I think it's a lot of the things we talked about already, which is doing your best to look prospectively at the risks. But the only true, like the best measurement of risk is historical credit losses. But as we talked about, it's hard to rely on those too much. Or actually, the easiest measurement of risk is historical credit losses. But going in depth, and when you're evaluating a credit manager or credit strategy, going in depth on the loans that they are underwriting today. How do they compare to the loans they were underwriting 12 months ago, 24 months ago, 48 months ago, in terms of like risk metrics, type of borrower, industry, structure, et cetera. And of course, all the usual things like that are strategy agnostic around, team and resources, et cetera. But particularly to a question, Steve, you asked earlier about avoiding defaults, having a credible workout team and capabilities in place is important. That's not something you can just sort of add on after the fact as a triage, sort of band-aid. You need to be, often the best way to avoid losses is to be recognizing the potential for losses well ahead of time. And as a lender being, on top of your borrower and doing your best to limit your risk to future scenarios you think are going to become more likely. So when we're looking at a credit manager, we're look for those kind of traits, lenders who have the ability and rigor behind their monitoring and workout capabilities.
Okay. We have a question on a smaller versus larger EBITDA size. So I think we think the bulk of the market is like middle market, very often sponsored lending.
Mm-hmm.
But now it's obviously going up to very large companies that could also maybe access the public credit markets or syndicated bank loans, also access private credit. So how do you look at those? What kind of interest rate spread do you need to to account for the additional risk that you might have, say, in a smaller company?
Yeah. So it's tough to say. The lower middle market, obviously you're taking more small cap type risk, and so there's a risk premium embedded in that. The lenders typically lend to lower debt to EBITDA ratios with better covenant packages than you find in the upper middle market for good reason. And the businesses tend to be, less robust. And that I think comes a lot with the size and the types of business, et cetera. So there definitely should be a premium there. And you can measure that in terms of what the market says is the right premium and based on the spreads of new deals. Over the last, the period that I was talking about where private capital was coming in place of the syndicated loan market, that had made the upper middle market more attractive on a relative value basis because there was a structural supply demand shift that favored the lenders. And so you could lend at higher spreads to larger, more stable, better capitalized companies. But that's not going to last forever. Already, as I mentioned, it's starting to fade away a little bit. And so there's always room, there's always a place for lower middle market. But at any given point in time, it's not always going to feel like the right relative value. The challenge is that typically when you're allocating to private debt, like a typical, drawdown fund or BDC, whatever, you are sort of making a longer term commitment and you're not necessarily timing your entry points into various areas of the market. And sometimes you're going to be overexposed to the lower relative value than you would like to be, but that's okay because you again diversify by issuer, diversify by vintage, and diversify by size, and you should be okay. There's no no way to optimize it in in a private capital market where you don't just get to trade in and out of it.
Okay, and I'm going to consolidate a few questions here because I've got a question on which strategies within private credit have the most attractive risk reward in today's environment, and then we have a couple questions on particular sectors. So one on infrastructure, considering the money that's going into infrastructure through the Inflation Reduction Act, and I've seen outside the U.S. seeing similar things. And then technology got brought up again. Kind of touched on that, I think, with venture credit, but I guess you could also go into non-venture technology companies.
Yeah. So I'll tackle infrastructure first. Absolutely right to identify the tailwind in the Inflation Reduction Act and the capital that's being pushed into the industry. I think that hopefully is a secular trend. And we're seeing a lot of infrastructure lending strategies, not necessarily being born out of this, but sort of gaining traction out of this, and for good reason. Historically, infrastructure has been an asset class that's lower risk, lower return, and so then when you're lending to it, it's even lower risk and lower return. But there's a lot of project financing where you are taking on some more risk, like development risk, et cetera, and takeout risk, et cetera. That can still be well underwritten and generate kind of low double-digit yields. And so with that secular tailwind behind it, and so that is an area that I think investors should be focused on. With respect to tech lending, I'll assume that the question may be related to like software companies and SaaS companies in particular. That's an area where a lot of sort of sponsor-backed direct lending. It's been a big use of their capital. Companies in the software enterprise software business borrowing, and then even what are called ARR loans or recurring revenue loans, where you're not lending to a multiple of earnings, but you're lending to a multiple of revenue because these companies are still in a growth stage and they're spending a lot on marketing. So to gain market share, with the idea that that cost structure is flexible and they could sort of flip that switch and start generating a lot of positive free cash flow. And it's been a robust source of supply of opportunity for lenders. The thing to keep in mind about enterprise software companies is, in the end, they're tied to industries. They're end markets. So certain ones are more specialized, serving particular industries, like in insurance or defense or whatever it may be, shipping. And so just while you may label it software, you need to pay attention to who the end customer is and how diversified that end customer base is. And of course, the sort of central core of the thesis around a lot of these investments is the high switching costs associated with that sort of business model. Meaning if you've integrated a software system into your business that's core to your operations and a mission critical, to use another sort of tag phrase that's common in the industry, then the cost of switching is very high. That creates stability and recurring cash flows, et cetera. So that's generally the thesis, the sort of common denominator, the theses behind these investments, and that there's a lot of it's real. It's a very real and robust thesis there, but there are always going to be companies that don't survive. The barriers to entry are lower than what they thought they were, and they're competed out, new technology, et cetera. So we haven't really seen that happen in any big numbers, but the question mark that everyone in the market has is, okay, what are the recovery rates going to be on those sorts of businesses? And that's where understanding the value of the IP, et cetera, comes into play. And so while it's not fully tested, I think it's very much a market that warrants, getting capital from lenders. And I think, the right approach can yield, pretty good results in terms of risk-adjusted returns. And the third element of that question was, I'm trying to remember now.
I think probably just what has the most attractive. I think we covered.
Oh, right.
Specific.
Look, I mean, I'll just give the cop-out answer here. It really depends on the risk profile you're looking to looking to reflect in your portfolio. Because going back to an earlier comment, there's no real hidden gem in the market. Information is too widely available, and for there to be any secrets. And to the extent there's higher alpha due to complexity, et cetera, often it'll be in less scalable strategies. So it may seem attractive, but then it's harder to scale. So then you're working with groups that maybe have less business stability and organizational stability. And so that's a risk factor you have to layer onto the analysis of the risk in the assets themselves. And so there's no simple answer to, or this opportunity is a screaming buy and this one's a screaming sell. As I mentioned earlier, with respect to lower middle market versus upper middle market, there are going to be waxing and waning of the relative value. You're not going to be able to time that. It helps to have a top-down view and to have conviction behind it, but we all know, generally we should never overestimate our ability to time markets. But you can, on the margin, make informed judgments about areas you think that are going to do better across a wider variety of economic paths. And I think that's probably the right way to do things, is to slightly over-allocate to those things that are where not just the expected return, but the variability in that return under different economic scenarios is lower. And sometimes that means trading off getting a lower return to do those things. And that's okay, because if you're just chasing yield, I'm stating the obvious here, but if you're just chasing yield, that's what's going to get you into trouble.
Yeah. Got it. Yeah, and interesting, going back to the technology sector, you discussed SaaS. I mean, since over the last 20 years, technology's kind of migrated from the most volatile cash flow revenue model to the least. It's very cyclical back around the 2000, and license sales could go to zero, where the subscription model at least seems to give you a little bit more of a predictable.
Whether you're a private equity firm or a lender, recurring revenues is is what you're looking for generally. I mean, the quality of recurring revenues a whole multi-factor grading system and scoring system you should assign to any recurring revenue stream in terms of the stability of it, the reliability of it. But that's sort of all else equal, an attribute that buyers of equity and debt look for.
So a question on, I think it may be a follow-up to the biggest risk on a recession, and not 100% sure how easy this will be to answer, but a question on the recovery rates if we are in a recession. There's, I think, limited history on the private side, but obviously there's quite a bit of data on bank lending and bond market.
Yeah, right. And we don't know, obviously. There's, when you have more loan-only capital structures, whereas like stretch senior lending, then all else equal, you'd expect recovery rates to be lower than when you had true first lien plus, bond or some other form of junior debt. So you always have to calibrate to sort of what the leverage levels in your portfolio, and calibrate your recovery rate assumptions around those, and and the industries you're lending to. But I think, for the sort of base case expectation for first lien is probably somewhere in the 60s. In a really bad recessionary environment, that would go down from there. When people are running bonds, like when they're evaluating CLO bonds, they're running their bonds through Intex. Sort of the classic assumption is 2% default rate and 70% recovery. Some people even run to 80, depending on how generous of a equity return they want to project. If you're taking that level of risk, you should probably be more conservative in your assumptions than that. Not necessarily in the default. I think 2% annualized default rate over the long term is, I think that's conservative enough. They're going to have spikes in that, obviously, but But the recovery assumption is one you need to pay a lot of attention to, particularly, just especially like, again, reflective of the particular risk characteristics of the portfolio that you own.
Great. Well, great. Appreciate the insights. This has been a great conversation. Thank you for the audience for all the questions. We're kind of up against time here, so I don't want to run over, but appreciate everyone joining us today, and hope to see you at another webinar soon. Thank you, Eli.
Yeah, thank you, Steve. Thanks, everyone.
All right, see you, everyone.